Good afternoon, everyone. I'm Pamela Hastings and welcome you to another Barometer Readings webcast. Joining us today, as always, will be our Chief Investment Strategist and President, David Burrows. And on today's webcast, we will be pleased to provide you a macro overview, as well as address your questions at the tail end of the conversation. So don't be shy. You can email me at phastings@barometercapital.ca or hit me up on the Q&A or the chat via Zoom. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Hey, Pamela, how are you today?
Good, thank you.
I want to welcome everybody to the call, and we've got lots of stuff to talk about. So why don't we jump right in? We're into the beginning of earnings. I think it's important to know that expectations for earnings on the quarter have been taken down pretty sequentially since the beginning of the year. In my opinion, we come into the earnings period with very low expectations. We're going to talk today a little bit about positioning, which is very cautious in the market against a backdrop where the market internals actually look pretty good. So from the top, why don't we kick off? We continue to believe we're in a structural bull market for stocks. This is the S&P 500 going back to 1982. And you can see from 1982 to 2000, we had this wonderful rising market where the S&P returned a little over 18% a year, but was marked by several sharp, short bear markets and corrections. Probably the most relevant one was the bear market heading into the 1990-91 recession, roughly halfway through that structural bull market. It lasted 18 months. At the worst point, it was down 20.5%. And really, by the time the recession began, the bear market was over. And then the market went on to rally from 1990 through 1994, 4 years of very productive markets. If we look at the current market that we're in, we have been above the rising 200-week moving average since 2013. We have tested it a number of times. In this most recent bear market that started, in January of 2022, we declined a maximum decline of 27.5%. It's taken so far about 16 months. We made our recent low in October, and month by month have slowly been climbing out of the basement, and this month find ourselves at about an 8-month high. Now that is against a chorus of Wall Street strategists talking about how this has not yet begun. We know the history, and the history is that a typical recession is discounted once the market has pulled back 18 to 27%, and that tends to happen over 9 to 16 months. So from a time perspective and from a magnitude perspective, we've seen the typical bear market heading into a typical recession. We've not seen what happens if you have some kind of a financial crisis like 2007 through 9. But at this point, there are little to no signs that we have that situation on our hands, and we'll examine that again today. So structurally, we continue to be positive on stocks, not just in the US, but globally. On fixed income, it looks as though we put in a generational low in interest rates in the 10-year treasuries in March of 2020, much like we did at the end of the 1940s. And from there, the world looked very different than it had looked like in the years leading up to that point. We had a reflationary world where rates moved higher in fits and starts. Share prices moved smartly higher while interest rates were going higher. There were recessions along the way. There were no major crises until the late 1960s. So you got 16 years of a bull market against rising interest rates and slowly increasing inflation. Again, it didn't happen all at once. It happened in fits and starts. We know that this period of falling rates that started in 1981 and was broken in 2001 is over. And in our view, after a sharp move higher in yields have consolidated but they are not headed back lower. If you look at it, TLT ETF, which is made up of 20-plus-year US Treasury bonds, since the beginning of the bear market, when rates started to rise, it fell to a maximum decline of 48.7%, but really has failed to rally to any extent since. In fact, continues to trade below the long-term moving averages that continue to decline. And despite the fact that billions and billions of dollars have gone into buying the dip in these bonds, investors would have been better to be buying the S&P. Stocks continue to outperform bonds. This is the S&P versus the TLH, the 10-year bond ETF. And even though we've been through a bear market in stocks, bonds did worse. So we continue to favor stocks over bonds. But that's not how investors feel. We know so far in 2023, $7.5 billion have been put to work in bonds on a net basis, while $3 billion have come out of US equities. Equities outperforming. Let's move on. Long-term picture for commodities. Bear market from 2008 through 2020 reversed. And just like equities and fixed income, they have long structural advances and long structural declines. The broad-based commodity ETF broke up out of a bear market in 2020, probably got ahead of itself by the spring of 2022, rallying 5 months while the S&P sold off, and eventually negative sentiment and concerns around a recession forced a pullback in commodity prices. These are monthly bars. It was a tightening range. And ultimately, when you get a tightening range and you work over and out an overbought condition, you'll break out one way or the other. Well, we broke out to the upside in the last month. So in my opinion, that was the first leg of a bull market, a consolidation, and we've started the second leg of this new long-term bull market in commodities. Now, DBC is made up of things like base metals, precious metals, things like cement, steel, and we know this is happening across the spectrum. We talked over the last little while about the fact that after consolidating for many months, oil broke out to the upside. We talked about how gold had broken out to the upside. We talked about how silver has broken out to the upside. And in this past month, agricultural commodities have broken out of this consolidation range to the upside. So this is not isolated. It's happening across the entire asset class. But this is a pretty universally disliked asset class. There have been no flows in the last 2 years into this group. Yet gold versus the S&P, just like it did in 2001, started to outperform and then outperformed until 2011. Again, has reversed versus the S&P and started to outperform, and it's the very beginning. The Goldman Sachs Commodities Index versus the S&P is at the end of a tightening range. My guess is, given that the subcomponents are breaking out higher, likely we will see the Goldman Sachs Commodity Index break out to the upside. Same for DBC, the broad-based commodity index, versus the bond market. Rallied since 2020, consolidated over the last 10 months, likely next to break out to the upside. So if I have to rank asset classes, I would rank commodities for a reflationary world, number one asset class, the best suited to deal with an inflationary world. Second, equities. When I started the investment business in 1986, we learned one of the most important investment tools you can use to beat inflation is to own companies that have an ability to raise price. And then third, fixed income, which has a use as ballast, but probably short-term fixed income is about the only thing that we would own. This is early days for relative performance of commodities versus stocks. So we keep an eye on the dollar because the dollar is a great measure of risk appetite. We know the US dollar was bid strongly against the euro and the yen and the pound during the bear market of 2022. It peaked out in and around the time the S&P made its lows and has been backing off since. The first leg down broke trend, broke support, eventually made a low in February. Stock market corrected in the month of March. US dollar rallied. However, US stock market found a low, global stocks found a low, started to rally, US dollar started to back off. And since then, we've seen commodity prices start to bounce again. So until this changes, my guess is that likely these themes continue. Let's talk about some of the economic data. We talked last week about the fact that employment data continued to be quite strong. We did a little diving into the numbers this week and found something quite interesting. There have been lots of talks around layoffs, yet the employment data is strong. California, weekly change in jobless claims by state, significant change. Well, we know that tech is based in California. Let's look at the other end of the spectrum. Ohio was the strongest state. Ohio, Indiana, Missouri, Georgia, Michigan, Illinois, Arkansas. This is the Rust Belt. This is industrial states. These are the states that are benefiting from some of the reshoring that's taking place in the US. Something to keep in mind as we go through the discussion today. We talked a little bit about CPI expectations and that we were expected to take a strong month of inflation data off and put a weaker month in. Well, inflation definitely did come down. When we look at the component makeup, we know that problematic areas, first of all, in 2020 and 21 and 22 were in orange, goods inflation. Well, you can see there's been very little or no goods inflation over the last few months. Second, we had food inflation. It's become a much smaller piece. Energy inflation, which has not been there. The sticky part has been services, but even services has started to come down. When we look at expectations, University of Michigan expectations and changes for inflation, when we look out forwards, it's been coming down. So there is a clear improvement in the spike in inflation, although inflation continues to be sticky. Now, we care about the economic data and we care about the earnings data. We can't tell you what the earnings numbers are going to be, although we believe that expectations are low going into the quarter. And so far, response to earnings data has been pretty good. But we like to use our tools. Our job is to use the process that we have to make our decisions and make sure that the portfolios line up with the current market condition. Our job isn't to be everywhere, but it's be in areas of market leadership. So what does that mean? It means areas that have a structural tailwind. We want to focus on the leadership themes, and that could be specific sectors or themes or asset classes that are benefiting from the current market environment. We're always watching for change, new leadership as it emerges, and old leadership as it starts to wane, so we can transition our holdings. And in the absence of leadership, have an ability or a willingness to sit on cash. So we're quite tactical. We look very unlike the market, and we use our process to make these decisions. Our top-down work is aimed at addressing the fact that 70% of return comes at the hands of getting to the right asset class and the right sectors within those asset classes. So my focus is to try to identify pockets of the market that are seeing net new inflows of capital. Where is money getting put to work today? The other part of the return structure comes from finding the right securities. Finding securities that are good, getting better within parts of the market we care about. And so our research team works diligently to look at a universe of about 60,000 securities to drill down to those that have both fundamental improvement taking place or acceleration and technical price action that would support that view. And where we can find securities that are good, getting better, both technically and fundamentally, and they line up in groups that we see are getting net new inflows of capital. That's where our portfolio should live. And then the third most important piece of the process is a very disciplined selling process. We use stop losses on everything. We only need 20 to 40 securities in a portfolio to be diversified. There's a lot of securities we can choose from. And so if something isn't behaving the way that it should be, given what we think we know, we use stop losses to take us out. The top-down work is all driven by breadth, trying to find sectors where over time a higher and higher percentage of securities are participating. And on the other hand, being cautious when we see deterioration in breadth where the leaders may continue to perform well, but the weaklings start to peel off or sell off. We know that there's no bear market in history that ever took place while breadth is expanding. When breadth is contracting, we'll raise cash, we'll tighten up our stops, and we stop putting any new positions on. That's not now. As of last week, we highlighted that our breadth model for the US market has been showing expanding breadth. The percentage of stocks in uptrends was approaching 50%. Percent of stocks globally in uptrends had been expanding. Around the world, the percent of stocks trading above their 50-day moving averages has been rising. Percent of stocks with positive weekly momentum has been expanding. Percent of stocks making new highs versus new lows is improving. And the percent of stocks trading above their 150-day or 30-week moving average through 50%. Well, we track this daily, and a week later, here are the changes. Percent of stocks with positive weekly momentum now over 80%. And the percent of stocks above the 50-day moving average globally has moved up through 50%. So despite some very negative views being expressed in social media and in research reports, underneath the surface, the market structure is improving. So it's not to say it can't weaken, but we've talked about some of the data as to how markets tend to behave after long periods of difficulty, and especially when sentiment gets particularly negative. Here's the S&P as of last week. We highlighted that coming out of the week before, we had a very significant swag breadth thrust, which is a significant number of companies making new advancing versus those declining. And that every time that had happened, 14 times since 1950, the market was up on average 23% the following year. A week later, markets continued to improve. Again, versus a chorus of people looking for economic weakness. So we can only trade the market that we have. It's not for us to trade a market that we think we should have. What we see internally is an improvement in the strength. When we have strengthening breadth, that is a shock absorbing system built into the market. A strong market should be able to absorb bad news and go higher. In the beginning of March, we had some very significant negative news about a couple of regional banks. The banking industry took it on the chin. The strong got stronger, and the weak remained weak. And it's not to say there aren't problems regionally, but that doesn't mean the market is in difficulty. Let's talk leadership for a minute. As of a week ago, we looked at the average sector, 38% of stocks were in uptrends. As sectors improve from a breadth perspective, they move to the right. So for instance, all of the sectors in this column have between 48 and 52% of companies in uptrends currently. Obviously, there's always strong ones and weak ones. But you can see at the right-hand side here, we have Wall Street, which is capital market banks and asset managers. We have builders. We have aerospace and defense. In the next column down, we have precious metals, insurance, machinery. These are economically sensitive groups. But when we move from April the 10th to April the 17th, we see that breadth, the average sector breadth, improved by 2.6% this week. Movement to the right. The market is improving. From a sector perspective, there's additional strength at the sector level. So let's talk about the important groups. The obvious one that everyone cares about right now is financials. This is the regional banks ETF KRE, a very significant decline at the beginning of March. And really, it hasn't gotten better. And we talked last week about the fact that we have no regional banks exposure. We do have financials exposure. It looks quite different. This is the capital markets ETF KCE, made up of companies like JP Morgan, Morgan Stanley, Goldman Sachs, made a low in October, a higher low in December, held its low in March while the regional banks got crushed, and have been working their way higher ever since. We're trading above the 200 and 150-day moving average, approaching the 50-day. And internally, some doing better than others. Our big holding, JP Morgan. And our top 10, our two major bank holdings are Royal Bank and JP Morgan. Both of them look very similar. JP Morgan reported its earnings. Clearly, the market liked them. They reported that their customers are in good shape and are seeing no sign of a credit crunch. Clearly, they were a beneficiary of new deposits as deposits moved away from regional banks. But that's why we like good getting better, not broken getting fixed. You're not hoping for something to get better to make money. You're expecting what is improving already to continue to dominate. And JP Morgan's certainly doing that. In the insurance space, again, very strong recovery off that sell-off in the financial sector as a whole. Fairfax Financial, one of our biggest weightings, up 4.37% today, approaching a 52-week high and trading very, very well. Just about half our financials exposure is in property and casualty companies, and they've been performing well. Let's move on. Technology started to improve from a relative strength perspective at the beginning of January. We started with small weights. We're currently at about 17% weight, which is a little more than half the market's weight. Our weight is in the very largest of large caps. We happen to own Microsoft, Apple, NVIDIA, Broadcom, Cisco, and Oracle. Within this group, the large cap tech stocks doing better. They tend to be more dividend return of capital focused companies, buying back shares and raising their dividends. And this continues to be the case. Industrials. Now, this is an important theme. The reason that we like industrials is because we believe that post-pandemic, there is a concerted effort by policymakers to reduce the reliance on China in the US. The change in supply chains and the change in political lines is driving a reshoring of activity in the US, along with major infrastructure spending. The VIS ETF made up of things like transportation companies, machinery companies, aerospace and defense companies, all of them currently benefiting. The conditions we're looking for, things that bottomed before the market did. This bottomed in June, made a higher low in October, a higher low in December, and a higher low in March. Trading above all the long-term moving averages this week, traded back above the 50-day moving average, and trading back towards highs. The point and figure price chart made a low in October, rallied sharply into December, and consolidated in a period of months. Since March, has made a series of higher lows and higher highs. And once we break out of this range, the target is considerably higher. So we talked a lot about the defense sector, and it continues to be prolific. The defense sector today closed at new 52-week highs. In fact, we're at all-time highs. Since the beginning of the bear market, this group outperformed the S&P by 30%, led by companies like Lockheed Martin, again, another name in our top 10. We talked about Lockheed Martin along the way. They reported their earnings today. Of their four major groups, aeronautics, which is jet fighters, rotary and mission systems, helicopters, space systems, and missile and fire control, all of them beat estimates. In the aeronautics group, jet fighters were held back from delivery over the last 3 months due to an incident with one fighter jet, which has been cleared, and the deliveries have resumed. And this is a company that's generating a boatload of cash. No surprise, their order backlog was up substantially over the quarter. This is now trading better than 87% of the companies in the S&P 500, trading at a new 52-week high today. Let's talk about another industrial theme. When we look at green energy transition and reshoring, probably there is no other more important set of infrastructure than the power grid. Power grid is being stretched as EVs are coming online and as manufacturing moving back to the US. A good supply of power becomes really, really important. The companies that supply into the power grid infrastructure are really important. There's an ETF GRID. This is it. Made a new 52-week high today, again, showing demand for electrical equipment. Moving on, energy. We talked last week about the fact that after a period of consolidation or resting, oil prices broke out to a higher level. Now, again, this trading range that we're looking at was in place from 2014 through 2022. That's 8 years. When you break out of a long trading range, and we're going to see a lot of these today, very often that means you're in the beginning of a new bull market. But it doesn't mean you go straight higher. When you get extended a long way above the moving averages, often you have to consolidate. But ultimately, when you break out again, you start the next leg of the bull market. So we talked last week about Meg Energy, close to a 52-week high. We talked about Imperial Oil. Today, I want to talk about one of the most important companies in Canada, Canadian Natural Resources. Now, this is a long-term chart. This is a chart going back to 2005. We know energy rallied into 2008, and CNQ traded sideways from 2008 through 2022, 14 years. So just like in stocks, you have structural bear markets and structural bull markets. And just like commodities, broke out in 2022. This month, we're breaking out of that range to the upside. In my view, this is the beginning of the next leg of the energy trade. Canadian Natural Resources has about 100 years of reserve life and no material capital expenditures to make over the next few years. Having paid down debt, they can return capital to shareholders by way of share buybacks and raising the dividend. And if we're looking for dividend growth, this is going to be one that we can look at going forwards. Materials. The materials sector now has outperformed the S&P by 22% since January of 22, trading above the level that it was at the beginning of the bear market. And this is made up of things like metals, things like steel. So let's talk about that again. Now, I put this slide up last week and said one of the problems that we see in the world is that a lot of the basic materials are produced in Russia, India, and China. These have become less reliable trading partners. Obviously, Russia, even less. 66% of the steel comes from Russia, India, and China. 65% of the coal, fertilizer, 45%, wheat, 42%. Basic materials are going through a major shift in supply chains. We know during the bear market that started in 2008, it put a pinch on capital spending. As prices came down, companies stopped spending money on new capacity. And in 2022, we had the first tick higher since 2012. Now, it's going to take a lot of spending to bring on enough supply to offset some of the challenges that we see. We've spent a lot of time thinking about the green energy transition and electric vehicles, and the fact that you need 3 times as much copper in an electric vehicle as you do in an internal combustion engine. Now, copper recently traded about $9,000 a ton. To put a new copper mine in place today, you're probably going to need something more like $15,000 a ton as the market price. So that's holding back investment. We know that the world uses about 25 million tons a year of copper. And what got produced last year was about 21 million tons. The rest would be accounted for by scrap. The copper producers ETF, made up of copper miners, has been moving its way smartly higher since September. In fact, we're now trading at a 52-week high, going back to its pullback in April of last year. Things we look for in a bull market. We look for things that hold up longer than the rest of the market. When it goes into a bear market, copper producers rallied for 5 months while the market was selling off, eventually succumbing. And then we want to see the group strengthen more than the market when the strength resumes. We know that if you go back to the beginning of the commodity rally in 2020, the copper ETF has outperformed the S&P by 122%. That is with last year's pullback. We have not enough investment taking place, and current producers are having a hard time maintaining their production. When we look at the long-term picture, the copper producers ETF put in a high in 2014. It didn't see that high exceeded until 2020. And since then, we've been through a pandemic, a major Fed tightening cycle, a supposed run up to a recession, yet we're trading very close to highs. That's resiliency in the face of weakness. That's exactly what we want to see. In a time of inflation, we want to know that companies we invest in have pricing power or the ability to get paid for the products that they produce. Now, we've talked about 4N Mining, which is a $1 billion small cap copper company coming into production, continues to work higher. We've talked about Capstone as a major holding. This is a $5 billion company. Of course, we've talked about Teck Resources, which this past month got a bid from Glencore, which the Keevil family has turned down with their controlling stake. But Teck Resources trades at about 4 times cash flow. Copper producers, pure play, trade at about 8 times. And once they spin off their Out Valley coal production, makes this a very, very attractive asset. Now, why is it that people are not happy about getting a bid? It's because you don't want to sell an asset when it's trading too cheaply. Teck Resources traded at about this price in 2011. Then over the next 12 years, went through a secular bear market. We've only just broken out of that secular bear market. If you look at the last secular or long-term bull market, Teck Resources went up about 700%. So as they're just putting in the first into production, the first major new copper mine globally in a long time, probably not the time to sell, but probably not a bad time to be a buyer. Gold miners broke out of their trading range. And so this is the point. Companies, sectors, asset classes come into and go out of favor. In 1991, ExxonMobil was the biggest company in the S&P 500. And then we had the tech boom. And by 1999, Microsoft was the biggest company in the S&P. When the market rolled over in 2001, I got repeated calls saying, is it time to buy Microsoft yet? And what did well over the next 10 years? ExxonMobil became the biggest company in the world again. But I can tell you in 99, nobody wanted to talk about ExxonMobil. Now, ExxonMobil peaked out in 2008. And as we move forward, we got another tech boom. And today, Apple, once again, is the largest company in the world, a tech company. So while I know people are focused on tech, when I look at these large resource companies breaking out of bases they've been in for 12 or 13 years and beginning a new bull market, I'd prefer to own Teck Resources than Apple today. And we happen to own both. But the fact is, we have to enter groups when they start their move and participate and be patient and ultimately get paid many-fold over for that patience. So here's how we're laid out today. Financials continue to make up about 20% of our portfolio, roughly 10% banks, that's JP Morgan and Royal are the major ones, and insurance companies. That's a significant overweight. And US banks went into a bear market in 2008, only to make new highs for the first time in 2020. That's the beginning of a new bull market. Technology, we have an underweight versus the S&P, but a significant weight in some of the dividend pairs. Industrials, we believe early stages of new bull market, a significant overweight from the S&P. Energy, slowly creeping higher after pulling back our holding in January, 11% versus the S&P 5. Materials, slowly continuing to build as a weight and about 3 times the S&P weight. Bonds, again, a short-term place to hold capital, or in our balanced fund, mandated to be a minimum 25% of the portfolio. Corporate bonds at about 4.7%, largely short-term. Again, we're trying to own corporate bonds in securities that are good, getting better. And then we have very low weights in things that are tied to interest rates, real estate, utilities, consumer staples, those are defensive sectors, and healthcare and communication services. The consumer, because there is concern around recession, is a small piece of our portfolio at only 5% versus 17% between consumer staples and consumer discretionary. So look, this portfolio looks very unlike the S&P. And in general, coming out of the bear market, we think the S&P will do just fine. But clearly, we believe that some of these sectors that are lesser owned and have been out of favor for a long time can be significant outperformers as we go forward. Now, outside the US, we know that we've gone through the first year in many where global stocks did better than US stocks. And when that begins, it tends to go on for a long time. And so far through the year, it continues to look like this is the case. The Euro Stoxx 50 has been rising relative to the S&P since September of last year, now trading better than 90% of all the companies in the S&P 500, making new 52-week highs today. The Mexican market, again, working its way higher. The Japanese market working its way higher. And China is starting to improve as they've reported strong economic growth and reasonable inflation. Outside of equities, commodities, fixed income is crypto. And this is a smaller investment for us. It's held in our macro portfolio, but both Ethereum and Bitcoin have been way outperforming the S&P. So far in the year, Ethereum is up 79% versus the S&P small single digits. So our macro portfolio is a diversifier. It looks unlike anything else we own, but it is focused in these large macro themes. It's a long short portfolio. It's long industrials, precious metals, energy, and various commodities. It has some global exposure in Europe, Japan, China, and Mexico. And it is short the US dollar, short real estate, which is hurt by rising rates, and short fixed income. We think our job is to try to create portfolios that are built for the current market that we're in, not the one that we've been in. Volatility is falling. Market's not showing concern of a major sell-off. And credit spreads, the stronger corporate credit minus the weaker corporate credit, are not showing signs of a credit crunch. So we've been putting this up every week. When you have a very weak 9-month period, like we did to September of 22, sentiment becomes really weak. But when you look out 6 months beyond these very weak periods, good things start to happen. 1 year out, very good things start to happen. An average 28% up the following 12 months, and 3 years out, up an average of 59%. So we think that we saw the lows in October. Another data point for you. When the S&P was up 7% in the first quarter, the full year returns were up every single time at an average of 23%. No negative returns. When the Fed is done its hiking cycle, which it may well be done in May, good things happen going forward. 1995, 2018, 2006, 1984, 1939. 2000 is an outlier. It's not impossible, but that's not the percentage odds bet. But this is the way people are feeling. While we think we saw the low in October, and while we continue to be above the rising 200-week moving average, and while we see breadth improving internally in the market steadily, and the market handling news effectively, this is the public opinion. JP Morgan published this week how their private investors feel. Their feelings were that the market would finish, 26% of their respondents felt the market would finish around 4,000, below where we are today. 55% thought it would finish at 3,500 or in that vicinity. That's way below where we are today, and 13% thought it would be below 3,500. Only 5% felt that it would be around this level by year end, and almost no one thought it could be at 4,500. 95% of investors felt that it would be below where we are today, which helps explain why investors have piled so much money into money market in the first quarter. It's why we can see that equity flows have been non-existent for 2 years. But bond flows against a bond bear market are strong. So people make investments often based on how they feel. They're feeling scared. They're feeling frustrated. It feels like a long time when the market goes through a correction like this, just as I'm sure it did in 1989 and 1990. But we want to be there for what comes next. And you're not going to make any money sitting in cash. Now, it's not that it's how we feel, it's what we're seeing taking place. From a positioning standpoint, we know that margin debt is as low as it was at the worst point in 2009, meaning there's very little speculation. So on top of the cash balances, there's very little speculating. We know that hedge funds have very, very low exposure currently. And we know that S&P futures traders are more short the US stock market than any time since 2011. This is exactly what we want to see at this point. I'm certain we're going to have some bad news out there in the market, in the economy, but the market already has had 16 months to make decisions to prepare for what they want to look like in their portfolios when bad news happens. It also means if news comes in even a little bit better than expectation, there's a ton of money that has to get put back to work. And we've shown over time, we're very happy to be defensive. And there were times through the course of the last year, we were very defensive. But this is not one of those times. And our view is that the market continues to show us internally that we look forward 8 to 12 to 14 months, likely things are a lot better. So with that, Pamela, if there's any questions, certainly happy to answer them.
Thanks so much, David. Yes, we have a few questions here. Brian would like to know how the investment team considers seasonality when making investment decisions. We've all heard the adage, go away and sell in May.
Yeah, certainly we have to watch that. I don't want to minimize seasonality. We know that in where we are in the election cycle tends to be a strong year. When I look at the stats around how a market behaves coming out of a bear market, it probably overwhelms the stats around seasonality. But it's certainly something we'll watch. If we were to start to see changes in our breadth models for the worse, then we certainly will take them seriously. That's how we make our decisions. But right now, all we're seeing is strengthening data. April tends to be the strongest month of the year. We're about midway through April, so certainly we'll watch for any sign of weakness. And then, of course, sector by sector, different sectors do well at different times. So we'll be watching that as well.
David, Lawrence wants to know your thoughts on fertilizer, specifically NTR and SQM, which also have large lithium positions.
Sure. So let's just take a look. Okay, so first of all, I want to put up the DBA. Let's just see if I can change the scale here. Take that log. Okay, so this is the agricultural ETF DBA. So you can see that this is April of last year, May, June, and of course we've seen firming up since January. We've broken out of this trading range to the upside, so agricultural commodities are showing some significant improvement. Over the period, we know that fertilizer stocks certainly pulled back. Let's see if I can make this a little bit better. Here we go. So fertilizer stocks pulled back around the time basic materials started pulling back. If we pulled up the FXZ, again, let's just see if I can just make that a one-year chart. Auto. Okay. So 1 year, yeah, it's 1 year. So this is where the material stocks started to pull back, and NTR did exactly that. pulled back around that time. We've seen recently the FXZ ETF start to show improvement. And we're seeing DBA, the agriculture stocks, start to show improvement. And I would expect that we will see NTR start to show improvement. We put in a low in NTR in April. We had a low back here in November, and we had a low back here in June of last year. So ultimately, I'd like to see this trade back above the longer term moving averages. Let's see if I can move this a little, make it a little bit more on the screen. If we look at it a lot like the rest of the commodity group, it's traded in a consolidated tightening range. And my guess is we've probably seen the lows, tested this same low twice. But again, what I'd like to see is it to move above about $81 before I added new positions here. But I think that this is likely to follow the rest of the commodity group that have all gone through this tightening range and consolidation.
Final question, David, comes from Sebastian. He wants to know if you can recommend any AI companies that you like in Canada or the US.
Look, you know, the way that we have decided right off the bat that we're investing in AI is through NVIDIA. NVIDIA obviously has had a great run since the beginning of the year. Their GPUs are probably best suited to AI. They also have built software IP to allow programmers to build applications using AI and their chips, so that they are probably a little ahead of other semiconductor manufacturers in that area. This is the way that we played it. There's going to be lots of sort of software type businesses that you can take a look at. And, you know, there's going to be lots of speculation. Again, we prefer to stay with sort of good getting better. And NVIDIA is really the cream of the crop in this area.
Thanks so much, David. That concludes the questions we've received this afternoon. And as always, I'll leave you with the final word.
Yeah, look, we are in the middle of April, and we are conscious of the fact that we're going to head into summer. But at the same time, we've seen a bear market, and we've seen rising lows since October. We see strengthening internals. And for our portfolios, I am very encouraged by the fact that we're seeing from a long-term perspective. And again, we look at this picture, you know, the beginning of new moves higher in many of our themes. So look, it feels like a long time when things like commodities consolidate for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months. Feels like a long time. But what we know is the second wave of a bull market is stronger than the first, and the next one is stronger than the second. So we're positioned, and we think that there's been a lot of risk running out of the market, and we think the leading securities are showing great strength, and we look forward to the next 2 to 3 years. And I know that there's lots of concern out there. We'll continue to use our stop losses where required. And if our breadth models change, we'll clearly, you know, make changes to our portfolios. But one thing, you know, for sure, we'll share that with you weekly. And so I encourage you to continue to log on with us each Tuesday. And if you've got questions you're too shy to ask, give us a call. I'm happy to jump on the phone with you or send me an email, and we'll see if we can answer your questions. So Pamela, thanks so much for being on the call today, and thanks everyone for tuning in. Hopefully you find these useful. And if you've got stuff you'd like us to cover, shoot us a message, and we'll get on it for next week. Have a good one.